Happy New Year to all our viewers. Welcome to the brand new chapter of Outlook Money's webinar series. This series is a part of the Investor Education and Awareness Initiative of Aditya Birla Sun Life Mutual Fund in association with Outlook Money. New Year is the time to make new resolutions based on the learnings and reflections on the past year, but it also gives an opportunity to relook at your finances and plan ahead in a more organized manner. I'm Nidhi Sinha, editor Outlook Money, and today I have with me industry veterans to reflect on 2021 and what should be the way forward in 2022 for investors. So let me move ahead and introduce our panelists for this discussion. First, I would like to welcome Mr. K.S. Rao, who's the head of Investor Education and Distribution Development at Aditya Birla Sun Life AMC. Mr. Rao's mission is to take financial literacy and investor education to various demographic segments across geographies to inculcate savings habit. He has spent about 2 decades in the mutual funds industry and is an alumni of IIM Calcutta. Welcome, Mr. Rao. We also have with us Mr. Amit Trivedi, who is an author, speaker, blogger, and trainer with over 26 years of experience in the capital markets and has most interesting insights about investing and personal finance in general. The third expert joining us today is Ms. Kiran Telang, who's registered as an investment advisor with Capital Markets Regulator, Securities and Exchange Board of India. Kiran is also a certified financial planner and has over 22 years of experience in finance and banking, including 15 years specifically as a financial advisor. So let's get started with today's discussion. And my first question is to you, Mr. Rao. So the COVID wave in the year 2021 played havoc with people's lives, the second wave in particular. What do you think were the biggest learnings from 2021 in that scenario?
Good morning, Nidhi. Thank you so much for having me here. And good morning to my co-panelists, Amit and Kiran. Indeed, wishing everyone a happy new year to all the audience of Outlook. And I'm grateful to the team Outlook always for helping Aditya Birla Sun Life Asset Management to reach out month on month on one or the other topic to the investors and engaging investors with some or the other current themes. And indeed, this theme, looking at the year has just begun, the reflections and resolutions is a more appropriate. Thanks for taking this forward. And yeah, it's a 2021. Probably it's a year of mixed bag. It was some kind of optimism for some time, pessimism for some time. And the biggest lesson I look at is world can change in a week. I mean, what we have seen in the second wave, everything we forgot, everything is going to be good. And the something else has come and the second wave impacted many of our friends, colleagues and families. And it has caused all that what can happen. You know, it was truly an havoc, you put the right word. But the best part of 2021 also, like, you know, it's 2020, we were more worried about the virus. 2021 has brought the optimism of the vaccine. And probably we were moving into the world of lockdown in 2020. 2021, we also seen lockdown to reopening of things and things were becoming better. And probably 2020 people were thought it's a recession, but 2021, it is beyond the recession, it is to be a recovery and the rotation. That way, I mean, you know, 2021 is reasonably a tough year to start in the first half. Second half was really good. And that has proved to all of us, personally, we are stronger than what we know. And probably another lesson I can look at is emergencies can come anytime. You can't predict. But all that you need to prepare, whether it is for the finance or your life. And the another lesson I look at is health is the true wealth, and the second part comes the wealth. I mean, ensuring your health by living with the right lifestyles, and also insurance could be the crucial way to look at. And these were the few things which I can recall how 2021 and probably have a change your outlook on the way you manage the wealth. That could be the message we can look at. You know, it's outlook for money should change, and well, it needs careful attention.
That's a very, very positive message. And like you said, Mr. Rao, the second half of 2021 was about hope and resilience. And in fact, the market scaled new highs. It scaled new highs at the beginning of the year. And then again, around September, it touched a new peak. So, my next question in this regard is to Mr. Trivedi. So, 2021, like Mr. Rao said, held out hope and the market saw new highs. But also remained very volatile, especially towards the end of the year, which was December, because it reached that peak of 60K and then, it came down and became very volatile. What do you think would have been, what should have investors made of such volatility, and how should they have dealt with it, really?
So first of all, thanks Outlook Money and Aditya Birla Sun Life Mutual Fund for this wonderful initiative, and a very happy 2022 to everybody. Nidhi, you asked a very pertinent question, and as you described, the year was a roller coaster of sorts when it comes to the health scenario as well as financial markets. We saw, as Rao sir was explaining, 2021 began with a hope that it looked like the pandemic was over, vaccine was announced in late December 2020, and things looked quite hunky-dory. And suddenly, in maybe April or so, we had a huge jolt. The second wave hit us very hard. And then we also parallelly saw the largest vaccination drive the world has ever seen. And not just, and of course, India was the leader in that sense in terms of numbers, but across the world, probably the largest number of people got vaccinated in the shortest possible time. And then that was a miracle of sorts, if one were to believe in those miracles, but this was caused by scientists and doctors. So that was one. On the equity markets, while it looked like there was a total disconnect between what was happening on the ground, the economy, the health scenario, and financial markets, 2022 looked like the two were completely decoupled. And suddenly we saw a newer height, Sensex breaching that 60,000 mark, and then suddenly falling. And once again, last few days, it's gone above 60,000. The interesting part about what and it sort of re-emphasized my belief that equity markets are volatile by nature, and they will always remain volatile. It's the true nature of these markets. And why does it happen? Because different people transact based on their opinions, and these opinions may be informed opinions or biased opinions, or taken under the spell of emotions, greed, fear, hope, whatever be the case. But these are opinions and not necessarily knowledge. And these opinions are very fickle. And to that extent, the markets also become very fickle. So how do you make money in such a market? Who can make money in such a market? So first of all, go back to the lessons of the entire pandemic. Improve your immunity. In the case of investments, improve the immunity of your portfolio. How do you improve immunity of your portfolio? So you maintain a diversified portfolio of good quality investments. That is better immunity. Number two, you wear a mask. In this case, you take insurance and maintain contingency fund. And then the third is you maintain social distance. So don't keep watching your portfolio every now and then, otherwise you're likely to make mistakes. Simple basic lessons, and that's how people can stay invested. And once somebody stays invested, in spite of these ups and downs, more often than not, in a good quality diversified portfolio in a growing economy like India, you're bound to make money.
Those were interesting analogies, Mr. Trivedi. So markets are still volatile, and I'll come to you, Kiran, with that. So according to you, you are a planner. What strategy should investors have to ride it? And how would you really describe 2021 was for the investors?
Thank you for the question, Nidhi. First of all, I'd like to wish the viewers a very happy new year and hope everybody stays safe in this rising pandemic time. So let me take this question in two parts. So when we look at what happened in 2020 from an investor's perspective, there were a lot of behavioral changes which came across. So few things which I found noteworthy was that the way people were investing and the way people were taking advice has really changed. A lot of people have started, listening to YouTube influencers. There are various digital platforms which are coming up with ease of investing. So all these things are actually, influencing the behavior of investors. So not only the advice given by these so-called YouTube influencers, but also, equating the ease of investing, the platforms that make it very easy to invest in various products is being equated to good quality investing, which should not be the case. There are a few other things which probably rhyme with what has happened in history. We saw a lot of IPOs coming up in this year when the markets were rising. So this has happened in the past and it is happening again. And people in the hope of making quick money are again jumping on the IPO bandwagon without taking the basic fundamentals into consideration probably. I think this is the kind of behavior that we have seen in 2021. On an overall basis, as Rao sir and Amit also mentioned before, for equities, equity investors, 2021 has been very good. I mean, people have made a lot of profits. But coming towards the end of the year, we saw a fall in the market. So while people who are long-term investors would not be phased by it, but people who had entered, say, after the pandemic, after March 2020, when the market started rising, a lot of them were probably first-time investors. We saw a spate of demat accounts being opened for the first time. So those investors probably would have felt a shock when they saw this downturn, because for 18 months since April 2020, we saw a one-way rise in the market. And when this downfall happens, it comes as a shock to people who have not experienced this earlier. So this is something that people need to understand. Now markets are volatile by nature. So we really can't do anything about it. And actually that is the reason people make money, because there is volatility. That is the primary reason why you make money in the stock markets. When I would say the strategy should remain for the long term is that you always be careful. You understand that the market is volatile by nature. You will not be able to control it. What you can do is control your own behavior. So let me talk about, market being a roller coaster. Amit was also mentioning, in fact, he also has written a book, Riding the Roller Coaster and Lessons from Investing History. When you go to a roller coaster, when you go to an amusement park and you want to ride a roller coaster, first of all, you will not go to any random amusement park, right? You will not go to a mela in the village which has put up a roller coaster, because there are risks. You will go to an amusement park which you feel is more regulated, is following the basic safety requirements meant for running a roller coaster in the first place. So in investments, you need to look at regulated products. So 2021 also saw a lot of unregulated products becoming very popular. So that is the first trap which you can fall into and lose money. Secondly, when you're riding a roller coaster, also you have the safety harness in place. You will not sit in a roller coaster without tying the safety belt. Likewise, in investments, have your safety nets in place. So have your emergency funds, have funds for your short-term goals in place, which is not linked to the stock market, and then go in for long-term investment for equity markets. So once these safety nets are in place, you will enjoy the roller coaster ride, because nothing is going to happen to you. You will come out of it safe and you will enjoy the thrill of being in it, and you will get what you want from it. That is, you want enjoyment in a roller coaster, you will get that. So in stock market, you want to create wealth. You will create wealth only when the basic safety nets are in place and you are okay with the ups and downs happening, which is by nature equity market, being volatile.
So yeah, Kiran highlighted, rightly highlighted the importance of having a safety net. And of course, 2021 saw a record number of demat accounts being opened. A lot of youngsters, entered the market who may not have the requisite experience to deal with the volatility. So in that scenario, Mr. Rao, what do you think should be the financial resolutions for 2022 for investors in general?
Yeah, thanks, Nidhi, for the question. And I will take from where Kiran was mentioning. I mean, probably before taking any resolutions, just you need to reflect on. And she put it very rightly. Always have a long-term view. I mean, that's a better way of any resolution, because short term anything can happen. I mean, and then, sometimes in 2021 we would have seen people, and 2020 they made a lot of money. Markets have made a lot of money, but they have not made money. And 2021 we had an expectation that we all make money, and it could be, I mean, of course it's Amit's favorite topic, but on the equity long term, I mean large cap would have given just 25% return, where mid and small has given more. I mean, anticipation was very high. 2022 may or may not be the same. We need to be prepared for it, and it's all that what we need to do is, before any resolutions, let go of the past. And every January, that gives an opportunity for us to relook at things, how you need to reflect, and what is the resolutions. Probably the one resolution for the last 2 years I look at is, we should never forget, is maintaining your emergency fund. That's a must, and that emergency fund can be little higher depending on the profile, depending on your income stream, depending on your background. One need to look at. Then the second one is adequate health and life insurance. These both, the both of them are truly important, and which can cause havoc. And we could see currently the Omicron. Fortunately, no hospitalizations. If there is an hospitalization, then everything can go for a toss, and have an adequate health insurance. And the third one is, I like the way Kiran put it. We tend to listen. Ease of investing is different, and investing is not easy is a different. And ease of investing, it's a click of button I can do. And I met an investor a couple of months back on one of the forums, and it was fortunately on ground event. And he was holding 65 folios during the lockdown, which he bought. Means, every investment advice he was listening, he was investing it. And that is, ease of investing. But investing is not easy if he is with a financial advisor. And probably it would have been, according to the goals, it could have been 10 to 12 folios, not 65 folios to manage. And here the resolution could be, the third resolution: stick to your asset allocation. That's going to be a primary one. And the last but not the least, none of us know how the market can play, and what kind of risk we need to take. But not taking the risk is the biggest risk, and take that calculated risk is the resolution. We need to keep it, while ensuring that you fund all your goals. It could be your child education to the retirement fund. And the one, which in the earlier Outlook Money conversations we used to have, Gaurav Mashruwala ji, and one message he always used to give it to is, on the debt side, how you can have a debt-free life, loan na loan. I mean, today we are like, the cheaper finance is available. Apart from housing loan, the personal loans also have gone up, and borrowing has gone up. Probably take a look at your debt. I mean, how best you can clear, and how best you can be clean, and you are buying an asset, not a liability. That could be one of the resolutions.
That sounds very, very useful, Mr. Rao. And I think there were a lot of takeaways for our viewers in the resolutions that you listed out. But I'll also take from what you said that, not taking any risk could be maybe the biggest risk, especially if you're investing in the equities. So with that, I'll come to Mr. Trivedi. So Mr. Trivedi, in 2021, we saw, like Mr. Rao also mentioned, that a lot of mid and small cap funds or stocks, they delivered better returns. But 2021, like we discussed, was also a time when the market saw new highs. So what do you think about 2022? With the current volatility, should investors switch to large cap funds, which are, relatively safer, relatively less risky in a way than compared with mid and small cap funds? Mr. Trivedi.
Yeah, so Nidhi, there's a very interesting and very common question. Whenever one witnesses volatility, one tends to reduce the risk on the portfolio. Having said that, when you are a typical investor whose full-time job is something else, I mean, you could be a doctor, you could be a teacher, you could be a corporate employee, you could be something else, but investing is not your full-time profession. In such a case, this timing of entry and exit, and depending on what is happening in the external world, which is the market, it's not easy, and it could actually turn out to be a very risky venture. Having said that, suddenly, I mean, can we say that last year mid and small cap funds were good and today they are not good? No, we can't say that, because each fund has a place in the portfolio. And as the popular tagline, the MFIS campaign says, mutual fund sahi hai. I would add one more to that. लेकिन कौन सा म्यूचुअल फंड मेरे लिए सही है? I think that question is equally important. So all mutual fund schemes are good, but in a certain situation, something may be appropriate for me, something may not be appropriate for me. Finding that is more important, and that's why if I have a long-term horizon, a mid and small cap portfolio could be a good idea if I have the wherewithal to stay invested for that long term. And where does that wherewithal come from? I've taken care of my immediate term requirements, short-term requirements, mid-term requirements. Then I can continue to hold on to that long-term portfolio. It's very simple. So let's say if somebody had a long-term portfolio without providing for next 3 or 4 years of requirements, then if something happens or if a large money requirement comes up, then one will have to dip into the long-term portfolio, which means you are forced to liquidate. So ensure that in mid and small cap or any such cases where the risk return profile is on the higher side, you don't have to resort to a fire sale. If you can maintain that, I think mid and small cap are good even today. Short term, I don't know what will happen. I mean, I'll say it in the same breath. I don't know what will happen in 2022. But are these schemes good for 2030 or 2035? My answer is yes.
That's very pertinent, Mr. Trivedi. Like you said, we all know that the riskier the schemes are, you have to keep it for the longer term to kind of balance out the risk and to get the maximum or most efficient returns, I must say. So, but a lot of investors really, they may not be that aware, and they really like things listed out to them on what is good for them and what is not good for them. So with that, Kiran, I would ask you that what, according to you, what should investors stay away from during 2022? But what do you think deserves a new chance in this year?
Well, see, just because it's a new year doesn't mean that the basic principles change. Every year we can keep asking ourselves this question, what's new?
Right.
So it's not like, going shopping ki aur dikhao. So in investing, it's always the same principles which stay. Investing is boring. I mean, if you seek thrill, this is not the place for you. So you can have thrill, you can enjoy with, investing money and treating it like a gamble, but keep it to a limited amount. I mean, keep a mad money account separately. I mean, if you have a few lakh rupees to spare, which you don't mind even if it doesn't come back to you, seek thrill with that amount. But your core portfolio, which is eventually going to create wealth for you, and which is going to help you live the life that you really want to, and help you fulfill your responsibilities of maybe sending your kids to college, and own your own retirement, buying a house, all those kind of things that normal families would want. So that has to be with the same old boring principles. I mean, it's as the cliche is that investing is like seeing the grass grow or watching the paint dry. So that remains true whichever year you are in. What I would say again is that go back and look at your investing, what you've done so far, and try and develop a holistic picture instead of just looking at investing in in a silo kind of a manner, in a separate box. Look at the holistic thing. I mean, when we were talking about emergency funds earlier, so those kind of things also you need to bring into the bigger picture, because if you don't have your emergency funds in place, if you don't have sufficient health insurance or life insurance, any emergency in the family, whether it could be ill health, loss of job, or a death of an earning member, that could totally derail your investments that you've built so painstakingly over the years, because you will have to dip into that, and it is definitely going to impact the future goal achievements. So when you look at things holistically, it changes your perspective. Then you will maybe not look at investments just for the highest return that any product might give. So first of all, have a holistic picture is what I would say, if you have not so far looked at it. Secondly, I would say that try and avoid things which are maybe getting very popular and everybody else is doing. I mean, look at the underlying of it, like we were talking about ease of investing, just because a platform is providing you the ease of investing doesn't mean that it is right for you. We have a lot of these new age investments which are being popularized. There is cryptocurrencies of all kinds. I mean, I was just reading there are around 15,500 cryptos and around 450 crypto exchanges which are there.
Mm.
So if you don't understand these things, don't go into it. Probably if you still want to try it out, look at that Mad Money account, because you might end up being zero after investing into these kind of things. Besides this, when the markets are doing well and when we are moving towards digitization, a lot of new things will come up. I mean, a lot of products which are yet unregulated are being offered to investors, and it is always in the same frame, that you will make a lot of money in a very short period of time. But the basic principle of investing says that it is not possible. And if it is possible, the risk is too high. So are you willing to bear that risk? Don't forget the risk involved in any kind of investment. So always go back to the basic and check whether what is being promised or what is being shown makes sense. I mean, a lot of common sense, applications will keep you away from these kind of things which can totally drown your money. I mean, unnecessarily it will be down the drain, and you will have to start from scratch again. So just be careful about these things. That is what I would say for the investors.
I think that is very useful advice, especially for youngsters who are crazy about cryptocurrencies these days. The government has been taking this conservative stance, and has been marking out the risks, the misleading ads, etc. But still, there is a lot of interest and a buzz around this area, which is considered a new avenue, but it is highly risky, like you said, and completely unregulated as of now, especially in India. So, in that background, Mr. Rao, I would like to ask you that this definitely needs a behavioral shift from the investor's point of view. What do you think are the other behavioral shifts that the investors should look at in 2022 for maintaining a healthy financial portfolio?
Yeah, I think you put it very rightly on the crypto, and I agree. The confusion crypto has created, and the method, the way you need to look at the broad scheme of things is not easy for anyone. The way statistics quoted by Kiran, probably we will get a sleepless night why we are investing and where we are investing and what we are investing. And as Benjamin Franklin rightly said, the investor's chief problem is he or she herself. And sometimes investment we think it is a number game, but it is a mind game. And taking care of the behavioral understanding, probably before you are understanding the behavioral changes you need to do, what kind of behavior impacting us in the last couple of years. If I look at, and digitization has made life much more easier for investing. That has made, I was just looking at analyzing the person whom I quoted earlier, 65 folios in a 1 year he has acquired. And it's a portfolio. And I was just looking at what made him. I was interviewing him, as asking him what he can do. Like every time there is an Amazon sale comes, every time there is an IPO, NFO comes, he is clicking the button. I mean, what is that? The biases he can look at, behavioral biases I look at is the availability bias. There is something is available and let me look at. And second bias I was looking at predominantly was an anchoring bias. Somebody is already invested, that group of his colleagues, all of them working from home, there is a chat which is happening, then there is an anchoring bias which is happening. And the last but not the least is the one he is looking at, how do I enhance my portfolio return? It's an adjustment bias. And here, what are the three things, if I can look at, sum it up for 2022 behavioral changes is like markets definitely may not be the way it is behaved 2020 and 21, and 22 could be much more volatile, and one need to be conservative. And here, the normal one, I call this is a line of control. It's a LOC biases. What is that line of control is? You have your loss aversion. Probably, if you have right asset allocation, you don't worry about the losses temporarily, which can happen. Have that loss aversion. And the LOC, the O is the overconfidence bias. And, we were so overconfident, like everything is going wrong, the markets are going up, then we think, nothing to worry. It's my honeymoon period is extended. I mean, it's just extended. It's not going to be a continued. Don't be overconfident. And the one is the third one is confirmation bias. It's like we always confirm to something is happening. And if you can readjust and relook at these LOCs, then the other biases, which normally, if you understand, it won't harm. Otherwise, it's harm. There is an acronym called HAARM. You have a herding mentality, you have an anchoring biases, you have a availability bias, and you have a recency bias and you have a mental accounting bias. But probably that need to look at. But predominantly, change in the behavioral is the LOC, loss aversion, overconfidence, and it's overconfidence and the confirmation bias.
I simply love the acronyms that you use, Mr. Rao, and that really, I think, helps our viewers understand some of the concepts so easily and so simply. But we've been talking about equity and cryptos and all of these risky assets. Now, coming to debt, Mr. Trivedi, debt funds didn't do very well in 2021. A lot of them gave single-digit returns, the debt funds. So, what should be the strategy, the debt strategy in 2022, especially now that you're hearing that a lot of central banks may raise rates, though the situation may be a bit different also because of this Omicron surge. But in the long term, during 2022, it is expected that that's what experts are saying, that central banks across the globe may raise interest rates. So, what is your outlook for fixed income or debt funds for 2022 in India?
That's probably the toughest of the questions, outlook on debt, because I have no hotline to any of the governors of central banks. So I don't know what they are likely to do. Having said that, on a serious note, while it is central bank's job to tweak the interest rate structure in the economy for achieving certain objectives of their own. I mean, they want to either curb inflation or want to push growth in the economy. Those objectives may not be aligned with an individual's investment objectives. So the investor better focuses on one's own investment objectives and decides how to play the, not really play. I don't really like that word. It's just a slip of tongue. But how to structure the portfolio, how to position the portfolio such that you have the desired outcome sort of. So first of all, let's say decide what is the objective or what is the role of that debt portion in the investor's portfolio. That's the primary question that I would ask, which means the broad three objectives of any investment portfolio: liquidity, safety, and returns. I don't think anybody is looking at a debt portfolio for returns, because then there are other riskier assets that you can look at. For example, equity, in order to achieve higher returns. Equity, nobody would look at for safety purpose. I mean, it will be foolhardy to look at equity for liquidity purposes. So typically, you divide your mutual funds into three categories. One is liquid, which is for the liquidity purpose. The debt portfolio is more or less for safety, and equity for returns or growth. That's the way I would look at it. Secondly, even within the debt portfolio, you look at your own profile as an investor, and if you are a not so savvy investor or you are a savvy investor, I would simply divide it in that way. Forget about risk profile for the time being. I'll come to risk profile also. But if you are a not so savvy investor, don't seek high returns from debt portfolio, because you don't understand debt markets that well. You will be in for a rude shock. Build a long-term diversified portfolio of good quality mutual funds for your long-term returns, and ensure you get safety and liquidity from the debt portfolio, which means you keep the average maturity of the portfolio on the lower side, and keep the credit risk also on a very low level. So that's the strategy that I would recommend for a very large number of investors who are not so savvy. Now, if you are a savvy investor, you can take certain risks within the debt portfolio and play the interest rate cycle or the credit risk cycle based on your understanding. There, I am not the right person to recommend, because you are already savvy. Then you don't need advice. But ensure that you maintain liquidity. You don't want to get killed by trying to extract that 1% extra out of the debt portfolio. But one of the points that you mentioned, in 2021, most of the debt the mutual funds delivered single-digit returns. My request to every single investor is, on your debt portfolio, be prepared to get middle single-digit returns, not higher single-digit returns also. So maybe closer to 6% on an average, or even lower, is where you should target, because the interest rates have gone to that level. overall in the economy. Don't expect a debt fund to pull a rabbit out of the head. It will not. And if at all the rabbit comes, you would not be happy looking at the losses in the portfolio. So please don't take risks there. That is supposed to be safe and liquid portfolio. So maintain it that way.
So, Kiran, like Mr. Trivedi said, absolutely, debt has a role to play in the portfolio. So, what do you think, what do you recommend for 2022, the investment strategy that investors should have in view of, the overall portfolio, their asset allocation, equity, debt, then considering the new avenues that have come into the market? So, what is the overall strategy that you would recommend to our viewers and investors?
Uh, See, Nidhi, it's actually very difficult to give a generalized view because when we talk about creating portfolios, they are supposed to be very customized because each person has a different risk profile, each family has different requirements. So how you design the portfolio depends on those factors more than how the external world is behaving. While we would have general practices or general principles in place which can overall create give you a guidance for creating a portfolio, when it actually comes to creating portfolios, it entirely depends on the personal situations. That's why it's called personal finance, right? It's personal before being finance. So say somebody who's young and initial part of their career, for them they can take much more risk than somebody who's closer to retirement, or somebody who has children who are about to go to college where there will be a large expected outflow of funds. So these way the things can be different for different people. On an overall basis, if you would look what aspects should be taken care of when you're creating a portfolio is first take care of the risks and then look into investing. So when you talk about risk management, as we were talking earlier too, first comes the emergency fund, which will basically take care of any short-term emergency cash requirements. Second would be the insurance to take care of the larger outflows in case of ill health or in case of death of the family member. So health insurance, personal accident cover, and life insurance. I mean, basically term plan, which will have lower premiums but a very high coverage rate. So these essential aspects need to be put in place first, and only after that you need to look into investments. Now, when you talk about investments, each person will need to first of all put down their goals, because most people, when they're not looking at the holistic picture, would just scout for products which are giving them the best returns, which is unfortunately not possible to get. And they might just get lost in the mess of so many products being available. Like Rao sir was saying, that person had 65 folios. So obviously there is no focus in that portfolio. So when you're creating an investment portfolio, first of all, list down your goals. What are your short-term goals? I mean, there could be something coming up in the next 2 years or 3 years. So those are your short-term goals. It could be anything. I mean, if you've made a down payment for the house, there could be a large outflow which you are expecting on completion of the property, which needs to be paid. Or it could be your child is going to college, or even 11, 12 standard where there are coaching expenses which can come up. So these are typical things that people need money for in the short term. So keep some money aside, like Amit was saying, in debt products, so which will not be volatile and which will not be linked to the stock market. So it will be safer. I mean, it will not have those kind of volatility in place. So pick up those funds for your short-term needs, and then your longer-term needs. Like if your child is still small, or if you just married, your child education goals and your retirement goals will be very far away. So you can and you should ideally put money into equity for those kind of goals, because you will live through the cycles that equity market tends to have over a period of time, and you will eventually create wealth. I mean, that is the only way to look at investing in equity. I mean, if your goals are so far away, look at equity. Once these things are in place, obviously you need to also take care of any eventualities that might happen. So how will your family access that wealth? So have nominations in place. Ensure that there are people in your family who can access the money. So if it's a couple, the husband and wife can be joint holder in bank accounts. Otherwise, I mean, if somebody is hospitalized or there is a death of one of the among the couple, how does the other person access the money? So these are practical considerations which need to be in place. So overall, this is a general structure of creating a good financial plan for yourself. within that structure, as I said, it will be personalized based on the family and the individual's requirements.
Absolutely, Kiran, like you said, personal finance has the first word is personal, so it is very important. So, what will be your strategy for the retired people, because they are in a separate category? Then with interest rates lower, their needs may get affected by debt interest rates or fixed deposit rates. So, what will be your strategy for them?
See, for retirees, it is important to understand two aspects. One, they need to be extra careful with their money because there is no regular inflow coming from other sources. Two, the retired period is likely to be very long because we have a longer longevity now. So you need to plan for at least, if you're typically retiring at 60, you need to plan for at least 30 to 40 years of expenses from whatever corpus you've built up so far. Now, depending on that corpus, the strategy again will vary between different retirees. But on a broad parameter, I mean, you can look at something known as a bucketing strategy. So, bucketing strategy, creates buckets of your corpus that you have, and some amount of money, say maybe 3 to 5 to 7 years worth of expenses, are kept in liquid funds and debt funds combination. So, which is less volatile, and some of the money is kept into equities. Now, why this segregation? So the first bucket, which is basically your debt bucket and liquid bucket, that is where you will be drawing your regular requirement funds from. So you have a certainty that, using products like a systematic withdrawal plan, where, every month there'll be some money coming into your account, which will take care of your daily requirements and, even other things like travel and all in normal circumstances. Uh, this will take care of a fund requirement for a few years, and you have some amount which is in the equity basket. Now, this equity bucket which is there is going to take care of inflation needs. So, in maybe 5-7 years, when the inflation impacts the amount that you need on a daily basis, you will need to, replenish the bucket of debt. So you take the profits that you have earned in the equity and move it to the debt bucket, and you continue using your funds and increase the outflow from the debt bucket. So that is the broad strategy that is used for retirees, and I think it makes sense because it also gives you some kind of peace of mind, because when you know that your next 5 years are taken care of, you have sufficient money to live on for next 5 years. The equity market volatility is less likely to impact you, and you're less likely to touch your long-term funds from that bucket. So this should eventually help you make your investment corpus last much longer than in any other strategy where you are, either totally looking at fixed income, which inflation will impact in the long run, or you're looking at equity in a larger amount, and it might impact your corpus itself when the market crashes.
Thank you so much, Kiran, for the detailed answer. Actually, a lot of retirees, they get confused about, whether to just stick with debt, and then, they have a long expectancy, and things may go haywire if they don't bucket, like you said. That strategy would be really useful. But this also brings me, towards the end of this discussion, which was on 2021 and 2022. But I would like to throw this one question to all of you, starting with Mr. Rao, that, what was the one takeaway from 2021 for you? And though you have spoken about the personal finance resolutions for the new year, what is the number one resolution for you? So these two things, if you could just throw some light on.
Yeah, thanks, Nidhi. I mean, one biggest learning what it's not for me, but I have seen for many of the investors is apart from not many managing the asset allocation, not having the will, which I have seen the biggest mistake people have done over a period of time. The resolution number one should be, I mean, even for me, that is, as a matter of fact, even I have not kept my right will. I was just looking at my nominations were they were not properly filled in most of the bank accounts where I have, and it's the resolution one, or the one resolution for me is complete your will, ensure that it is available. That could be the first way, and the second I can put again as a will only. The will is that you should always have a hope that things will always be better, and that hope is always for me HOPE, hold on, pain ends, and be positive that way. So.
Yeah, that pun on will, I think, is useful for everyone. It's not just your will for your family to secure your family, but also the will to kind of live and be hopeful and look ahead and all of that. So, so coming to Mr. Trivedi, for you, what was the one reflection that stood out in 2021, and what is that you would like our viewers to take away for 2022? What was that one lesson that they can take away?
There are actually three lessons rolled into one. Uh, looking at the behavior of a lot of investors, be it cryptos or NFTs or even IPOs or opening demat accounts, my simple message to everybody is, "Dil mein aata hu, samajh mein nahi," is a good line for Salman Khan to get claps from the audience, but it's a very bad investment approach. And samajhna is more important in this case. So what is to be understood? Number one, all investments are subject to certain risks, not just mutual funds. While mutual funds highlight this fact in the advertisement, all investments carry some risk, and it is important to understand the risk before investing, not returns, risk. And the second message is, ease of transacting does not equal to ease of making profits. I think this much is something that I would leave the investors with as far as what we saw in 2021. And these are the lessons to remember.
Okay, and what about you, Kiran? As in, what is your one takeaway from 2021 and one resolution that you would like our readers to take in 2022?
Well, the lesson that I would say is that life happens. We really don't have any control. There is just an illusion of control. And I would like to just reiterate that there is always hope. Not losing hope is very important. From an investing point of view, I think my continuous resolution is that do not lose faith when the markets are down, and do not get overexcited when the markets are running up. If you are able to do that, I think most people would be able to create huge amounts of wealth in their lifetime.
So these were some valuable lessons, like Mr. Rao highlighted, the importance of will, especially, last year we saw so many breadwinners, family breadwinners lose their lives due to the second wave of COVID. There's so many things happening. There are so many natural disasters that hit us. So the importance of will, even if it sounds morbid to some, it is really, really important to face that reality. And like Mr. Trivedi said, to know and understand the risks, what you are getting into, is equally important. And similarly, like Kiran said, that life happens, but you have to take it and take it positively, and understand the risks, and the basic needs that you that you need to have as an investor to be successful in your financial life and even your personal life, because ultimately these things are intertwined and they help your overall life. So that was a really vibrant discussion, I think, the New Year discussion. And thank you so much, Mr. Rao, Mr. Trivedi, Kiran, and thank you for joining us on Outlook Money and the Aditya Birla Summit. Thanks a lot.
Thank you so much, and
Thank
wishing
you.
all the audience very happy and prosperous New Year. Thanks for this session, and looking forward for many more to come. Thank you so much.
Good day and Happy New Year.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.